Welcome to the Deep Dive. Today we're tackling U.S. individual income tax prep, cutting through the complexity.
Yeah, we've got this really detailed course document for tax preparers.
Right, and our mission really is to pull out the essential stuff you need to understand your own filing.
Think of it like a shortcut.
Exactly. Get the basics, data gathering, filing status, dependents, without, getting totally lost.
Yeah, the goal isn't making you a tax pro overnight. It's about giving you a solid base.
Practical understanding, flagging those common mistakes.
So you can feel, hopefully, a bit more confident come tax season.
Okay, let's dive in. Where does this source say we start? Preliminaries, right? Gathering data.
Yes, and it immediately flags something important, last year's return.
Why is looking back so vital? Seems counterintuitive, maybe.
Well, it's your guide to potential savings this year. If you ignore it, you could miss carryovers.
Carryovers, like what?
Things like net operating losses from a business, maybe a prior year minimum tax credit, depreciation details, asset basis, stuff like that.
Ah, okay. So missing those could mean leaving money on the table this year.
Precisely. You need that history to get the present right.
Makes sense. Then there's a basic info name, date of birth, marital status.
The essentials. But also residency, citizenship, dependence, and crucially, those tax ID numbers.
SSN, ITIN,
Yeah.
ATON. That one's less common.
Right. ATI is the Adoption Taxpayer Identification Number.
Okay.
It's used when parents are adopting and changing the child's name and getting a new SSN. The ATON bridges that gap on the tax return.
Interesting detail. And ID verification comes up strong, too. Photos, SSN cards, ITIN letters.
Yeah, the IRS is serious about this. Partly identity theft prevention, obviously.
Which is huge.
Absolutely. But also, just practically incorrect TINs, taxpayer ID numbers, are a major reason returns get rejected.
So double-checking those numbers saves a lot of headaches down the line.
Definitely. Delays, hassle. You want to avoid that. California even has an optional ID field on the return now.
And the source mentions a very specific, sad exception regarding SSNs.
Yes, for a child born and deceased in the same year who might not have received an SSN.
How is that handled?
You can still claim the child, assuming all other dependency rules are met. You actually write died in the SSN field on the return.
Wow. A small but important allowance.
It allows for proper recognition in a very difficult situation.
Okay, moving on. The source lists the main 1040 forms. The regular 1040, 1040SR for seniors.
1040NR for non-residents, 1040X for amending, plus territory forms.
Quite the family. What's the main takeaway for most people?
Just that the system tries to cater to different situations. Most listeners will probably just use the standard 1040 or the 1040SR if they're over 65.
Good point. Don't get bogged down by forms you likely won't need. Now, ITNs, again, individual taxpayer ID numbers. Who needs those?
Primarily people with a U.S. tax obligation who aren't eligible for an SSN. So think non-resident aliens with U.S. source income.
Okay.
And a key point the source makes, having an SSN doesn't automatically mean you're authorized to work in the U.S. They're separate issues.
Got it. And enroll agents can actually help people apply for ITNs.
Yes, using Form W-7. We can assist with that process.
Okay, so info gathered. Now filing. Deadlines. April 15th is the standard, but it moves.
Right. If the 15th is a weekend or holiday, it shifts. For 2024 returns, it's looking like April 14th, 2025.
Mark your calendars. And mailing. Postmark is key.
Absolutely critical. Get that official USPS postmark by the due date. That's your proof of timely filing, even if it arrives later.
And paying online. Watch out for declined cards.
Yes, if your payment fails on the due date, it's considered late. And e-filers, your payment needs to be scheduled by the due date, too.
Okay, penalties. Nobody likes them, but we need to understand them. Failure to pay versus failure to file. The source says failure to file is worse.
Much worse, generally. The penalty is significantly higher. It can range from 5% up to 25% of the unpaid tax.
Wow.
Whereas the failure to pay penalty starts at just 0.5% per month. So the big message is file on time, even if you can't pay immediately.
And interest applies too, right? On
Right.
top of penalties.
Yes. Interest accrues on any unpaid amount, and there's no upper limit on that.
Ouch. Okay, what if you really can't file by April 14th? Extensions.
Yes, you can file Form 4868 for an automatic 6-month extension, usually pushes the deadline to October 15th.
That helps.
But, and this is crucial, it's an extension to file, not an extension to pay.
So interest still piles up from the original deadline if you owe.
Exactly. You need to estimate your tax and pay what you expect to owe by April 15th to avoid interest and the failure to pay penalty.
Got it. And there are special extensions for certain groups. People abroad,
Yeah.
military.
Right. U.S. citizens, residents living and working abroad, non-resident aliens with no U.S. withholding, active military outside the U.S., they often get an automatic extension to June 15th.
And potentially even longer for those living abroad.
Yes, there's a possible discretionary 2-month extension on top of that, potentially to December 15th. And combat zone rules are very specific.
Combat zones.
Yeah, for service members and certain civilians supporting them, deadlines for filing, refunds, payments, they're automatically suspended. It lasts from when they enter the zone until 180 days after they leave. Significant relief.
Definitely needed. Back to penalties for a sec. The failure to file minimum penalty if you're over 60 days late and owe tax.
That's an important one. The minimum penalty is the smaller of $510 or 100% of the tax due.
So if you owe, say, $300, but file over 60 days late.
Your penalty could be $300, doubling what you owe. It's a serious incentive not to delay filing that long if you owe money.
But no penalty if you do a refund, even if you file late.
Correct. No penalty if no tax is owed.
And if both penalties apply in 1 month, failure to file and failure to pay.
The IRS actually reduces the failure to file penalty by the amount of the failure to pay penalty for that overlapping month. So a small bit of coordination there.
Okay, and the failure to pay rate is 0.5% per month, capped at 25%, unless the IRS gets serious.
Right. If they issue a formal demand for immediate payment or a notice of intent to levy, that rate jumps to 1% per month.
Now, can you get penalties waived? Abatement.
Yes, penalties can be abated for reasonable cause, things truly beyond your control, like a disaster, serious illness, inability to get records.
But interest.
Interest generally cannot be abated. Even if the penalty is waived, you'll likely still owe interest on the late tax payment.
Okay, file and pay on time is the clear message. But income isn't always steady. Which brings us to estimated taxes, the pay-as-you-go system.
Exactly. The IRS wants tax paid roughly as you earn income. So withholding from a job or quarterly estimated payments if you're self-employed, have investment income, etc.
And those cover income tax, self-employment tax, maybe AMT.
Correct, all included.
The due dates are pretty regular, April, June, September, then January 15th of next year.
Yep, around those dates, adjusted for weekends and holidays. Postmark counts for mail, but online is usually easier, safer.
And there's a special rule for farmers and fishermen.
Right. If they meet the income requirements, they can either file and pay everything by March 1st, or make one estimated payment by January 15th if they can't file by March 1st, accommodates their income flow.
Now, avoiding the underpayment penalty, the safe harbor rules, how do those work?
They give you ways to avoid the penalty. You just need to meet one of these. Pay at least 90% of your current year's tax liability.
Oh,
Or pay 100% of your previous year's total tax. Or owe less than $1,000 in tax for the year after accounting for withholding and credits.
so meeting just one of those shields you.
Correct. And if you had zero tax liability last year, you're generally exempt from the penalty this year.
Unless you're a high-income taxpayer. There's an adjustment there.
Yes. If your adjusted gross income, AGI, is over $150,000, $75,000 if married filing separately, that 100% of prior year tax safe harbor becomes 110%.
Makes sense? Now, how do you adjust payments during the year if your income changes? W-4 for employees.
Exactly. You give Form W-4 to your employer to change withholding, not sent to the IRS.
And W-4V for Social Security.
Right. That's for voluntary withholding from Social Security benefits, useful for retirees with other income.
And if you do underpay, or think you have a reason not to be penalized, Form 2210.
Yep. Form 2210 is where you calculate the penalty or request a waiver explaining your situation.
Lastly on this topic, backup withholding. Sounds ominous.
It can be. It's 24% withholding that payers, like banks or brokers, must take if the name and SSN you gave them on Form W-9 don't match IRS records.
Like when opening a new account sometimes.
Yeah, uncommon then. The IRS sends notices when it happens.
Okay, shifting gears to a sensitive area. Married filing jointly returns. What if one spouse messes up? Innocent spouse versus injured spouse relief, they sound similar.
But they're quite different. Innocent spouse relief is about being excused from tax, interest, and penalties on a joint return caused by your spouse's errors, like unreported income that you genuinely didn't know about when you signed.
So knowledge before signing is key.
Absolutely. And it's not automatic. It often involves a detailed review, sometimes even tax court. It only applies to joint returns.
Got it. Now, injured spouse relief, what's the injury?
The injury is having your share of a joint tax refund taken by the IRS to pay your spouse's separate past due debt. like old student loans or back taxes that aren't your responsibility.
So your money is being used for their debt.
Exactly. And you weren't legally obligated on that debt. This relief is specifically about getting your share of the refund back.
How do you claim that?
You file Form 8379 Injured Spouse Allocation. It separates out your portion of the refund.
Okay, clear distinction. Now, special filing requirements. Amended returns, Form 1040X. We mentioned it, but the time limits are key.
Generally, you have 3 years from when you filed the original return or 2 years from when you paid the tax, whichever is later, to file that 1040X to claim a refund or make corrections.
And if you filed an extension originally?
The 3-year clock usually still starts from the original filing date, not the extended date, assuming you filed before the extension ran out.
Are there exceptions to that refund deadline? Reasonable cause.
Yes, things like fires, disasters, serious illness, inability to get records. Those can be grounds for extending the time.
And some specific situations have longer built-in deadlines.
Right. Bad debts or worthless securities give you 7 years. Foreign tax credits or payments, 10 years. There are also special rules for things like net operating loss carrybacks, certain credit carrybacks, military personnel, disaster areas.
Good to know there's some flexibility. Now, the flip side. The IRS's time limit to assess more tax against you. The statute of limitations?
Generally, they have 3 years from when you filed your return, or the due date if you filed early.
3 years.
Unless you file late, then it's 3 years from the actual filing date. Or if you don't file at all or file fraudulently, there's no time limit. The clock never starts.
Okay.
And if you substantially understate your income more than 25%, they get 6 years.
So, file accurately, file on time. And how long do they have to collect the tax once it's assessed?
10 years from the date of the assessment, basically, the bill date, not the filing date, though some states, like California, have longer collection periods.
And e-filing old returns. Is there a limit?
Yes, you can typically only e-file the current year and the prior 2 years. Older returns usually have to be mailed.
And again, failure to file means that assessment statute stays open forever.
It really hammers home the importance of just getting that return filed.
Okay, huge topic now. Filing status. This affects everyone. You might qualify for more than one, but you pick the one with the lowest tax, right?
That's the general rule. And the 5 main statuses are single, married filing jointly, MFJ, married filing separately, MFS, head of household, HOH, and qualifying surviving spouse, QSS.
Let's tick through them. Single. Seems simple.
Pretty much. Unmarried, legally separated via court decree or divorce by December 31st. State law determines marital status, and foreign marriages are usually recognized.
Married filing jointly, MFJ. Often the best tax-wise.
Generally, yes. You combine income, deductions, credits. Can file even if only one spouse has income. But both must agree.
If they don't agree.
Default is usually MFS, unless one qualifies for something else, like HOH. MFJ criteria include living together as married, common law marriage recognized by the state, living apart but not legally separated, divorced.
And a widow can file MFJ in the year of death?
Yes, if they haven't remarried by year end.
Okay, married filing separately, MFS. The alternative for married couples.
Right. If one chooses MFS, the other generally must too. You report your own stuff. Can be beneficial sometimes, maybe if one wants only their own tax liability or maybe with high medical expenses for one spouse.
But usually disadvantages.
Often, yes. Higher tax rates generally. Lower limits or disallowance for certain credits and deductions, like the capital loss limit is $1,500 each. If one itemizes, the other can't take the standard deduction. No student loan interest deduction.
So usually not the best, but sometimes necessary or rarely better. Can you switch from MFS to MFJ later?
Usually, yes, by amending the return. But you generally can't go the other way from MFJ to MFS after the deadline.
Okay. Head of household, HOH. This one can save money compared to single or MFS. What are the keys?
It's got more hoops. You need to be unmarried or considered unmarried on the last day of the year.
Okay.
You need to have paid over half the cost of keeping up a home.
Rent, mortgage, utilities, food at home. Not clothing or vacations.
Exactly. And a qualifying person must have lived in that home with you for over half the year. There are exceptions for temporary absences, dependent parents.
And that qualifying person has to be related in a specific way.
Usually, a qualifying child or certain other relatives like a parent, sibling, niece, nephew, in-laws. A foster child can also be a qualifying person for HOH.
But not, say, a cousin living with you all year, even if they're dependent.
Correct. A cousin could be a qualifying relative dependent, but typically not a qualifying person for HOH status unless they also meet foster child rules.
What about that considered unmarried rule for HOH? You can still be legally married.
Yes, if you meet all these, file a separate return, pay over half the upkeep of a home where your qualifying child lived more than half the year, didn't live with your spouse the last 6 months of the year, and you can claim the child as a dependent.
Okay. And dependent parents for HOH, they don't have to live with you?
Correct. As long as you pay over half the cost of maintaining their main home, could be their house, or even a nursing home. Qualifying parent includes step-parents, in-laws too.
And this specific disregarded non-resident alien spouse situation for HOH.
Right. If you're a U.S. taxpayer married to a non-resident alien NRA, you can potentially file HOH, but basically ignoring the NRA spouse for this purpose, even if you live together. But you can elect to treat the NRA spouse as a resident for tax purposes, and you need another qualifying person, like a child or parent for HOH status. The NRA spouse can't be the qualifying person.
Very specific. Okay, last status. Qualifying surviving spouse, QSS. Least common.
Yes, it's less common, but it's beneficial. For the 2 years after the year your spouse died, you can use QSS status.
What does it get you?
Same standard deduction and tax brackets as MFJ. Big help.
Requirements.
You must have been able to file jointly the year they died, not have remarried by the end of the current year, have a qualifying child, stepchild, adopted, not foster, living with you all year, and paid over half the cost of the home.
And after those 2 years?
You'd likely file as single, or maybe HOH if you qualify then. And if you remarry in the year your spouse died, the deceased spouse's final return is usually MFS.
One last thing here. Annulment.
Annulment means the marriage is treated as if it never happened legally. So you'd need to go back and amend any returns filed as married using Form 1040X within the statute of limitations.
Wow, okay. Filing status is covered.
Yeah.
Let's pivot to residency for tax purposes. Resident versus non-resident alien. Big difference in how you're taxed, right?
Huge difference. Resident aliens, like U.S. citizens, are taxed on worldwide income. Non-resident aliens are generally taxed only on U.S. source income.
Citizens use Form 1040. Non-residents usually 1040 NR.
Correct. And there's also the possibility of being a dual-status alien in 1 year, part resident, part non-resident, maybe the year you arrive or leave. Those returns have to be mailed, can't be e-filed.
How's residency determined? Green card test.
That's the simple one. If you have a green card at any time during the year, you generally meet the test and can choose to be treated as a resident for the whole year.
And if no green card, substantial presence test.
Right. This is the main test otherwise. You meet it if you're physically present in the U.S. for at least 31 days in the current year and at least 183 days over the last 3 years using a weighted calculation.
Weighted?
Yeah. All days in the current year, 13 of the days in the previous year, and 16 of the days in the year before that. Add them up. If it's 183 or more, you generally meet the test.
But some days don't count. Exempt individuals.
Exactly. Days spent here as a foreign government official or temporarily as a teacher, researcher, or student on certain visas, like F, J, AG, generally don't count towards the substantial presence test within limits.
And there's a closer connection exception, too.
Yes. Even if you meet the day count, you might still be considered a non-resident if you maintain a tax home and closer connections to another country, like Canadians wintering in the U.S., but clearly based in Canada.
And a non-resident can choose to be treated as a resident if married to a U.S. citizen resident.
Yes. Under specific election rules, they have to agree to file jointly and treat the non-resident as a resident for the entire tax year.
Okay, final big area. Dependents. Qualifying child or qualifying relative? What are the basic tests for both?
3 main hurdles first. 1. Dependent taxpayer test. You can't claim a dependent if you can be claimed as one.
Okay.
2. Joint return test. The person you're claiming generally can't file a joint return unless it's only to get a refund and neither spouse owes tax separately.
Right.
And 3. Citizenship or residency test. They must be a U.S. citizen, U.S. national, or resident of the U.S., Canada, or Mexico, with an exception for certain adopted kids.
Got it. Now, qualifying child tests are stricter. 5 of them.
Yes. Relationship, age, residency, support, and tiebreaker. Child, stepchild, adopted child, sibling, step-sibling, half-sibling, or a descendant like a grandchild, niece, nephew. Also, a foster child placed by an agency or court.
Age.
Under 19 at year-end. Or under 24 and a full-time student for part of 5 months. or any age if permanently and totally disabled. And the child must generally be younger than you, unless disabled.
Residency.
Lived with you for more than half the year. In your home. Exceptions for temporary absences like college, illness, divorce situations.
Support. This is key.
The child cannot have provided more than half of their own support. Scholarships for full-time students don't count as the child supporting themselves. State benefits are usually state support.
Okay, so it's about whether they paid for more than half their own keep.
Exactly.
And the tiebreaker. If, say, a child lived with mom and grandma.
Right. It sets the priority. Parents filing jointly win first. Then the parent the child lived with longer. If equal time, the parent with higher AGI. If no parent can claim, then the qualifying person with the highest AGI gets to claim. There are specific rules.
Okay, now, if someone isn't a qualifying child, they might be a qualifying relative. Different tests.
Yes. 4 tests here. First, they cannot be your qualifying child. That's test 1.
Makes sense.
Second, the member of household or relationship test. If they aren't related in specific ways, they must live with you the entire year.
But if they are related, child, parent, sibling, in-laws, etc.
Then they generally do not have to live with you. Interestingly, relationships by marriage, like a mother-in-law, don't end upon death or divorce for this purpose. Foster parents aren't on the related list here. And household employees can't be dependents.
Third test, gross income.
Yes. The qualifying relative's gross income for 2024 must be less than $5,050. That's a specific dollar amount, includes most taxable income.
And finally, support test again, but different.
Yes. For a qualifying relative, you must provide more than half of their total support for the year. This includes housing value, food, medical, etc. It's about your contribution versus everyone else's combined.
Okay, so qualifying child support is about their contribution. Qualifying relative support is about your contribution.
You got it. Cue difference.
What about divorced parents claiming a child? Custodial parent usually claims.
Yes, the parent the child lived with more. But the custodial parent can release the claim to the non-custodial parent using Form 833D2.
So the non-custodial parent can claim the dependency?
Yes, if they attach that signed form. But this release is generally only for the dependency exemption child tax credit. It doesn't usually transfer eligibility for head of household status or the earned income tax credit. Those typically stay with the custodial parent.
Important distinction. Lastly, multiple support agreements. What if a family chips in together to support, say, an elderly parent?
Exactly the scenario. If multiple people together provide over half the support, but no single person provides over half.
Then no one can claim.
No, they can agree among themselves who gets to claim the dependent. That person must have provided more than 10% of the support. Everyone else in the group who also gave over 10% must sign Form 2120, agreeing not to claim the dependent that year.
So one person claims per year, with agreement from the others.
Precisely.
Wow. Okay, we have really covered a ton of ground. A true deep dive into the essentials. Preliminary data, deadlines, penalties, estimated taxes.
Innocent and injured spouse relief, special filing rules, and then the big ones. Filing status, residency, and all those dependency rules.
Yeah, and hopefully some aha moments for you, the listener. Things like the ITN versus SSN distinction, or how harsh that failure to file penalty can be.
Right, or the specific requirements for head of household, the differences between innocent and injured spouse. It's not just numbers, it's understanding the rules behind them.
Absolutely. Our goal was really to give you that shortcut, that solid foundation on these core tax concepts. Hope we did that today.
So, this brings up a final thought for you to consider. Given how interconnected filing status and dependency rules are, how might big life changes, marriage, divorce, kids growing up and moving out, really shift your tax picture in the future?
Yeah. How could it impact what you owe or what tax savings you might be eligible for? And maybe what steps could you take now to understand and prepare for those kinds of inevitable changes down the road?